We all know that one guy. You know who I'm talking about. He drives the leased BMW, wears the $500 watch, posts photos of bottle service every weekend, and talks constantly about how much he's crushing it at his job. From the outside, his life looks like a perfect spreadsheet of success. But if you actually peeled back the layers, if you looked at his bank account, you'd see something terrifying. You'd see maxed out credit cards, zero emergency fund, and a net worth that is technically negative. He isn't wealthy, he's just really good at revenue recognition while ignoring his liabilities. He is living a lie, and eventually the repo man comes for the car and the landlord comes for the rent. Now, imagine that guy wasn't just a person, imagine he was a company worth $60 billion. This is the story of Enron. It wasn't just a scam, it was the greatest psychological trick ever played on Wall Street. And the scary part? You might be making the exact same financial mistakes they did, just on a smaller scale. I spend way too much time thinking about corporate disasters and what they teach us about our own wallets. If you're someone who feels like everyone else is getting rich while you're just trying to figure out where your money went, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Today, we aren't just talking about fraud. We are talking about the psychology of money, the danger of arrogance, and how the smartest guys in the room were actually the most financially illiterate people on the planet. Let's rewind to the year 2000. If you were an investor, owning Enron stock was like owning Apple or Nvidia today. It was the stock. They were named America's most innovative company by Fortune magazine for 6 years in a row. 6 years. The guys running the show, Jeff Skilling and Kenneth Lay, they weren't seen as criminals. They were treated like rock stars. They were Harvard MBAs. They were visionaries. They were supposed to be the smartest guys in the room. Here's the thing. Human beings have this massive psychological flaw called the halo effect. When we see someone who looks successful, sounds confident, and wears a nice suit, we automatically assume they are competent. We assume the math works because they say it works. Enron claimed they were reinventing the energy business. They weren't just moving gas through pipelines. They were trading energy like stocks. They created a market for weather derivatives. They were trading bandwidth for the internet. On paper, their revenue was skyrocketing. In 2000, they reported revenues of over $100 billion. To put that in perspective, that's more than what companies like Microsoft or Google were doing at similar stages of their growth. But here is what most people don't realize. There's a massive difference between making money and reporting revenue. And this is where it gets really interesting. To understand how Enron fooled everyone, you have to understand a boring accounting term called mark-to-market accounting. Now, don't click off, stay with me. This is crucial because I guarantee some of you do this in your own heads. Let's use an analogy. Let's say you open a lemonade stand. In traditional accounting, if you sell a cup of lemonade for $1 and it costs you 50 cents to make, you book a profit of 50 cents. Simple, right? You count the cash when it hits your hand. But Enron used mark-to-market. In this world, you open your lemonade stand and you say, I project that over the next 10 years I will sell 1 million cups of lemonade. So you take the potential profit from those future 1 million cups and you book it as revenue today. You haven't sold the lemonade, you haven't bought the lemons, you haven't even squeezed a single lime. But on your financial statements, you tell your investors, look, we made $500,000 today. Jeff Skilling convinced the SEC to let Enron use this method. It allowed them to book the entire estimated value of a 20-year deal the day they signed the contract. Here's the problem with the math. What if the price of lemons goes up? What if nobody wants your lemonade in 3 years? What if it rains? Enron didn't care. If the actual numbers missed their projections, they just adjusted the model. It was hypothetical future money, treated like cash in the bank. Now, you might be thinking, Nick, that's insane corporate fraud. I'd never do that. Really? How many times have you put a vacation on a credit card because you're expecting a bonus at the end of the year? How many times have you bought a house you can barely afford because you assume your salary will go up in 5 years? That is personal mark-to-market accounting. You are spending future money that you haven't earned yet. And just like Enron, when that future doesn't happen, you crash. So Enron was booking fake profit, but they still had real expenses. They had to build power plants, lay fiber optic cables, and pay those massive executive bonuses. When you have fake income but real bills, you end up with a lot of debt. And Wall Street hates debt. If Enron showed too much debt, their stock price would drop. So enter Andrew Fastow, the CFO, the financial wizard. He created something called Special Purpose Entities, or SPEs. Think of it like this. Imagine you have maxed out your credit card with $50,000 in debt. If the bank sees that, they won't give you a mortgage. So you create a fake company called Nick's Awesome Consulting. You transfer your credit card debt to that company. Technically, you don't have the debt anymore. The company does. But here's the kicker. You run the company, and the company has no money. It's just a shell to hide the bills. Enron did this hundreds of times. They named these shell companies after Star Wars characters like Jedi and Chewco. They moved billions of dollars of debt off their books and into these shadows. Look, the math was staggering. They were hiding something like $30 billion in debt. They were basically playing a shell game. As long as the stock price kept going up, they could use Enron stock to guarantee these side deals. It was a Ponzi scheme dressed in a suit and tie. Now, you can't pull off a fraud this big without a culture that supports it, and this is where the psychology gets really dark. Enron had a performance review system called Rank and Yank. Every 6 months, they ranked all employees. The top 15% got massive bonuses. The bottom 15%, they were fired immediately. Think about the incentives there. If your survival depends on hitting a number, and you know the guys at the top are fudging the numbers, what are you going to do? You're going to lie. Traders were manipulating energy grids in California, causing rolling blackouts just to spike prices and make their numbers. They were hurting real grandmas and grandpas, turning off their AC in the summer just to get a higher ranking. It creates a culture of short-term greed over long-term survival. And again, bring this back to your life. If you are constantly trying to keep up with the Joneses, if your self-worth is ranked by what car you drive or what watch you wear, you will make toxic financial decisions. You will sacrifice your long-term security for a short-term status boost. That is the rank and yank of personal finance. It works until it doesn't. In 2001, the dot-com bubble had burst, the economy was slowing, and people started asking questions. A reporter named Bethany McLean asked a simple question: how does Enron actually make money? Jeff Skilling couldn't answer. He actually called an analyst an asshole on a public conference call for asking for a balance sheet. That was the crack in the dam. The stock price started to slide. Remember those shell companies? They were backed by Enron stock. When the stock dropped, the debt came due. All of it, at once. In a matter of months, the stock went from $90 to pennies. $74 billion in shareholder wealth evaporated. 20,000 employees lost their jobs, and worse, they lost their retirement funds. Enron had encouraged employees to invest their 401ks entirely in Enron stock. Jeff Skilling got 24 years in prison. Ken Lay died of a heart attack before sentencing. Andy Fastow went to jail, but the smartest guys in the room proved that you can have a high IQ and zero financial wisdom. So why did I just spend 15 minutes talking about a company that died 20 years ago? Because the trap they fell into is the same trap waiting for you. Number 1. Radical transparency. Enron died because they lied to themselves about their numbers. Do not mark-to-market your life. Sit down this weekend. Look at your actual income, not what you hope to make next year. Look at your actual debt, not the monthly payment, the total balance. You have to be the CFO of your own life, and you have to be a brutally honest one. Number 2, diversify. Enron employees lost everything because they had their job and their savings in the same basket. Don't bet your whole financial future on one stock, one crypto coin, or one asset. If Enron can go to zero, anything can go to zero. Number 3, check your ego. Complexity is often a mask for fraud or stupidity. If you can't explain how an investment works in one sentence, like, I sell lemonade for $1, don't buy it. If someone promises you guaranteed huge returns with zero risk, run away. That's not genius, that's a scam. Real wealth isn't about looking smart.
It's not about complex derivatives or hiding debt. It's about spending less than you earn, investing the difference, and having the patience to wait. It's boring, it's unsexy, and it works. Don't try to be the smartest guy in the room. Just try to be the guy who isn't broke. If you found value in this, share this with a friend who might be drinking a little too much of their own Kool-Aid. Don't forget to subscribe because I'm going to keep breaking down these stories so you don't become one of them. I'll see you in the next one.